And joining me on the podcast right now and live, of course, in video, it's Paul Hill with his yellow tie and his smiley face, equity analyst, full-time investor. You all right, fella? How's things?
Yeah, well, the weather's nice. It's sunny outside. It's warm. It's lovely. So, yeah.
And
no,
one of your stocks is at the 52-week high, equals. So that's also a good thing. That's nice to see. It's finally broke out. I looked at it in a webinar last night. I said, look at this. Equals tried about 6 times now to break this £1 level. And it's had a few issues, but it's building up. It's got a bit of energy there. And it's finally done it. It'd be nice to see. Oh, in fact, it's just dipped below it. I mean, it's looking like it's trying to break that £1 level so many times. It'll do it in the end. It's just when, you know?
Well, they had their capital markets day yesterday for institutions. I didn't actually attend, but I'm guessing they just reiterate their sort of long-term strategy. And when they can bolt on that Uznex's acquisition out in Belgium, when that completes, it's been hopefully finally approved by the authorities out there in June. But they also came out with the trading updates on Wednesday, I think it was, or Tuesday. I can't remember exactly. But basically, they're having their caking and eating it. I mean, they're growing their top line at 47%, largely driven by increasing revenues per day from their solutions business in particular, but really overall in every area as sort of SME companies and large caps to get the benefit of their sort of bank rate forex payments straight through processing platform. And more people are starting to, they say, well, just love using equals, and that get that viral marketing going, and treasurers speak to one another and they sign up. So the actual the sales like for like are going to the moon. And then what's really surprised me was that gross margins had ticked up to back to 50%. And I just thought, wow, that is incredible. Because if you actually think about it, usually that's two competing forces. You don't usually see strong top line growth and an increase in gross or variable margin, but you got it here. And that is really a tip my hat to them, because that is a fantastic achievement. I was struggling not to upgrade my forecast, even though they said they were going to be in line. And I guess that's because they're probably going to be, sort of like when that Unex acquisition does actually complete, they'll actually have to absorb that business and grow it, because they know it's loss making. So they're probably just being ultra conservative. But it was just fantastic, the optics that, and if they do that and then right size and integrate that business and use it as the launch pad into Europe with that straight through bank processing. I mean, next year, 2024 could be just another inflection point. I mean, really, if the UK market is generating what? They're going to be on a run rate of around about 90 to 100 million when they exit this year. Yeah, on turnover side, if you look at Q4, that may be even slightly higher, I don't know, but a big number. That's just from the UK. So the European market, if you push the clock for 2, 3, 4 years, I mean, it's 8 times or 6 times the size of the UK market in terms of Forex international straight through processing. So, and it's just the same. It's the same product, and they'll obviously ride on the coattails of existing customers in the UK to use that service out in Europe, and they're already being asked to do that. So, hey, the problem I have, I'm absolutely delighted, and I've been banging the table for 3 years on this stock. And when I bought it, it went down by about 20%. And I was still saying, I think this long-term strategy is really good. The problem I have now, which is a high-class issue, is that it's just such a large part of my portfolio, and with fins, I've got Argentex as well, but particularly equals. Then at some point I will have to, just on portfolio risk management purposes, top slice, which I don't want to do, because I actually think this business has got great. I'm not planning to do it in the near future, but at some point I will have to do it, because it's just too big a position. But I'm absolutely delighted. The management team's doing a terrific job. The business is really well placed going forward. And you never know, this is a consolidating sector. I know they're buying up the cheap, basically buying up good quality tech companies that haven't got the cash to be able to grow, and they're doing that, and they're hoovering up some good businesses. But equally, you could see a larger fintech player putting a number on equals, because it's got something that not many people have.
Yeah. No, listen, that's a lovely problem to have when a company goes in the right direction and it takes up a bigger part of your portfolio than you're comfortable with, because then, any sort of sway in the share price moves the whole portfolio around. So it's annoying, but it's good. But, I've had that problem before, and people said to me, how much do you put in? I said, well, it depends. Listen, as far as coverage is concerned, or exposure, I say, there's two different things. Don't overexpose on a downtrend if you're piling money in, but it's not so bad if it's going in the right direction and you get overexposed when it's going in the right direction because things are going right. Something's happening right with the company. So it's not a bad problem, but I wouldn't pile money and average down and get overexposed. That's the wrong way.
You really raise an important point. Yeah, averaging down. I mean, the key to remember about this principle is that you're wrong quite often at the time. And let's be clear, I've been doing this for over 30 years and I'm wrong nearly 40% of the time or 37% of the time. Over the last 30 years, that's the average, okay? So I'm wrong quite often. And what that means, if I'm doubling down on losers, actually I'm putting more money into the areas that I am, that I am wrong. I've just got to accept that I am wrong on it. And so that principle, that's why doubling down, particularly in the small cap area, is highly dangerous. Now, a little birdie tells me, Justin, that you've managed to sort of, because I mean, you can make money, obviously, on your winners, but it's just as important to avoid losses on your, with shares. And my little birdie tells me that you've managed to avoid a couple of asteroids in your direction.
I've had three. I was on a little loss. What I've been doing recently is, like I said, that kind of, in a bull market, pretty much, if it's really buoyant, averaging down the company's going uptrend is fine because you're buying a dip, but like in a downtrend, you're buying a downtrend. And if you are going to average down, I would highly, recommend putting I'm not going to expose yourself to more than say 10% of my portfolio value or 5%, whatever it is, but have an upper limit. Don't keep going and averaging down because that way you can be catastrophic and fatal for your portfolio. So if you're going to average down, having a total exposure value percentage limits like 10% or 5% and never go above that. Be disciplined. But I wouldn't average down in this market. No, it's hard work. But no, I don't know. Charlie Munger always, one of the quotes he said recently, he's 100 years of age nearly, but Charlie Munger, of course, Warren Buffett's right-hand man, partner, he said, it's easy to avoid stupidity rather than seek brilliance. And it's true. Avoid stupidity and you do quite well because not many people can seek brilliance, even though those guys are brilliant. And a couple of things I've had recently is almost not trying to pre-guess results. Because in this market, if the results don't, exceed expectations, then they'll take a hammering. And three companies I jumped out on in the last week or so, and I was really lucky. I mean, first one was ASOS. I literally.
They got an absolute pummeling, didn't they?
Yeah. Well, I only had 2% exposure to them. The morning before their results, I thought there's something wrong here. It broke down below £7. There's a support level there. There's something going wrong here. And I was I think about 20% down. So I just cut and I thought, that's it. I'm just getting out. Luckily I did because they did another 20% on the results. They've gone on even further. So they're on £7 and they're at 4 or 5 quid now.
They're worried about, apparently the market's worried about their debt, aren't they? In terms of whether they're going to have to raise more money, fresh capital. And if you try and do that in online fast fashion retail, you're going to get taken out to the woodshed. So, it's going to be really painful. Just look at what happens at Superdry, and they're not. They've got their own brand. It was distressed levels, and then the only way they got them at the actual placing away was because the founder stepped in and took a big chunk. So you're right. Well done. Tip your hat to avoiding a huge loss.
Oh yeah. I mean, I was looking at the interim figures there, and their cash has gone down pretty much to 308 million. But their debt from 323, but their debt has gone up from 475 to 740 million. I'm thinking, okay, if you're making a profit, it's not a problem. But when you're losing, 272 million in operating, I mean, that's worrying. That is really worrying. And I think the margins are also wafer thin. And even though there's forecast to be a bit of upside here, I don't see it. I think, even if there is upside, it's not a lot. There's better risk reward elsewhere. So I literally just, run the figures previous to that. I thought they broke down below 7 in the chart. I thought, this is not good. Something's going wrong here. And so I just cut and run.
Well done.
That was one.
And what about Future? Because Future came out.
Future again. I only had a small bit of Future PLC. Again, that started going down again. Future, the share price started going down, and I thought, what is going on here? And it wasn't any strength in the share price. And I only had 1% because I like the company. I think they could do well, but going forward, and the margins are all good. The growth has been good, but when you built yourself on good growth and good margins, and there's no growth there, you start to suffer. And they're saying that the macro environment is not as good. But
I do wonder, just on a broader point for that whole industry, I do wonder for advertising, digital advertising, whether it's going to be disrupted by generative AI, because we heard 3 weeks ago, Chegg out in the States, that ed tech player, got cut in half simply because it just mentioned that it was being cannibalized by students who are not paying its subscription fees for its services and instead just going free to ChatGPT. And I do wonder ultimately whether this whole digital advertising, you've got to be really, really careful, in my view, that you select the beneficiaries of generative AI, not the losers. And it's very difficult at this stage to actually decide who is going to be the winners and losers, because there's going to be massive disruption.
Yeah. Well, you know, I did search for artificial intelligence in their interim report today, and they do mention it, machine learning, they say they're benefiting from that and all that stuff. But I mean, if you look at it, I mean, they didn't have any growth here at all. But you know, they've dropped about 16 to 17%. But revenue of this is interims 404 million, operating profit of 84 million, pretty much. The debt has come down a bit to 421 from 542. They got cash there, but the margins are, you know, still decent margins there. They got, like, you know, operating margin about 20%, net margin of 14, operating cash flow 21. So, and they're on a PE now of 10, and previously, historically, they're way above that, you know. And so going forward, it'll be interesting to see how they perform. But as yet, the share price is in a downtrend. Where it'll bottom out, I've no idea. But therein lies the opportunity. You know, it could go a lot lower and it could get a lot cheaper. But again, is that you got almost a perfect storm, like you say there. You've got AI coming around the bend, which could affect the whole industry. Plus, you've got, you know, in this kind of environment where people are worried about recessions, you know, advertising budgets are cut massively. So we don't know where it's going to go. In fact, you know what? After last week, you mentioned about AI, I contacted Moneysupermarket, and they did get back to me, and they said they are working with AI and machine learning as they speak. So they're very much into that, and this is a very exciting space. So Moneysupermarket,
that's interesting to know, because my dad owns. My dad, I've been having this debate with my dad as well in terms of Moneysupermarket.com.
Yeah, and they did say watch this space. They said watch this space. So I don't think I announced something on that, but they said they already use a bit of it anyway with Google algorithms and all that, and machine learning and all that. But they are experimenting more with it, and they'll be doing their own stuff with it. So yeah, it is. Do you know, it's quite scary thinking about this area, isn't it? What will be disrupted and what won't? Because it seems like there are certain industries that will be disrupted more than others. You know, at the start we all thought it'd be lowly paid workers, but now they're saying like the law parts of soliciting and all that stuff.
Law's going to get absolutely.
There's so many different areas because of a lot of data and documents and
accountancy, financial, white collar jobs. Yeah, absolutely. Anything which has got a semblance of sort of like, you know, intellect and repetition, that really is going to be you know, sort of like in danger. But it isn't just the cost base, which could save companies a lot of money. It's really the revenue. It's where do you generate your current revenue? And I'll just take it as an example for, say, Moneysupermarket.com. I, as a consumer, as a household, you spend, let's just say, you know, £5,000 on all your energy each year, etc. Because I've got a reasonably sized house, etc. And I go into ChatGPT and say, right, okay, I'm living in Birmingham. I've got a 4 or 5 bedroom house. It's myself, my wife, and a bunch of cats, and we have some friends around and stuff like that. This is our sort of like our needs. Where is the best, you know, sort of like provider that we want? And it will come out, and then we go into ChatGPT, and because it's powered by, let's say, Amazon, or it's powered by Microsoft, or even Google, and it comes out with one answer, and it's tailored specifically to me. And that's the risk for somebody like Moneysupermarket.com.
Well, I see Moneysupermarket using that, though. I see them, because they have the SEO for all that kind of comparison. They would embed, you know, some ChatGPT into their system, and they would be searched up as one of the first results if they're doing their, you know, if they're doing what they should be doing.
But why would they be the first? I don't understand why would they be the first result? Because effectively Microsoft would come out, ChatGPT would come out with the answer that I'm looking for, and it could be anybody. It could be one of the just directs to the supplier rather than actually going through a portal.
Because people are still using a search engine. Search engines now are embedding, you know, AI, so the search engine will still be used. So that part of it.
I'm not using the search engine. I just go straight to
I know, but but most people do, and in fact, there will be an amalgamation of that. There won't be ChatGPT and a search engine. It'll be ChatGPT in a search engine. So and so that's what will happen. So I think SEO will still be used in some respect, and the best companies will be able to, you know, exactly use that kind of technology. And like I said, if they are, I did say that to them. I said, listen, it's going to revolutionize the industry. You know, early sort of adopters of this industry will do very well. And they did say, no, we're well into it, and we already used to use it.
Well, look forward to hearing what it is.
Rolling it out. because yeah, I mean, the best results. If for example, if Moneysupermarket are bringing up the best results on comparisons because of energy tariffs and stuff, that will still be sort of used via AI engine, because they'll say they've still got the best data. The best data will be pulled forward. So as long as you're the best at what you do,
exactly, they've got to justify the value that they charge their customers to get to that table. Basically,
I listened to an amazing podcast on AI recently. In fact, I'll try and find what it is. I'll put a link in the thing, but it was you realize, it literally are scratching the surface at the moment of this, and it's quite scary how it'll revolutionize everything, and even down to sort of especially where you get high risk sort of phase 1, 2, 3 biotech trials, clinical trials, and the potential for AI to data mine the probabilities of outcomes and all that stuff. So there's so many areas, but we're at the start of it, aren't we? And
what was the other one you missed? Sorry, the other asteroid you missed. The third one
on the beach. So a lot of companies have been doing well, sort of in the booking. I don't know if you noticed. I don't know if you go on holidays, but we like to go abroad, and the price of holidays have gone up massively. I think this is going to flatter revenues, of course, but the costs maybe there. I thought these got to come down. They're just ridiculous. There was a hotel we booked like a couple of years back, and we got it for something like 5,000 for all inclusive in Mexico. My wife Googled it, right, and it was 80,000 for the same holiday. I thought, what? That's going to be wrong. She left her a week, and it's still 80,000. And literally, even now, it's about 3 times the price it was. And so, I don't know what's going on. But I looked at on the beach, and I thought that they're going to do quite well, because they've raised some money during the bad times. They're like 65 million, 120 million market cap. And even though they come up with their interims, and again, the ship started drifting. I thought, what's going on here? And it hit the sort of support level. I just got out, and I prefer to wait and see the results rather than pre-guess the results. And revenue was up revenue was up like 38%. Operating profit was up 3%. But they've gone from having no debt, and 64 million in cash, to having 30 million in debt and just under 10 million in cash. I thought, what? And when I read the last report, they said we are investing heavily in our technology, and they're quite bullish on the figures. They were very vague on them, saying they're 66% up on this time last year. It's hard to search it. And I thought, when companies are vague on figures, and they said they're investing heavily, that basically means they're going to burn a lot of cash, and the figures aren't going to be that good. So that in my mind, I thought, right, I'm out. I thought, how have they burned that much cash? And they're not only that, they're taking on debt. So in my mind, I was out, and I'm glad, because they dropped again.
So how much? What's your total cash holding now? Then,
right now, I literally got 48% cash.
Wow. Okay. So you got plenty to deploy.
Yeah. And I've been ill-disciplined of late. When we sort of had the rally a while back, I jumped into lots of companies. I thought, oh, this is going to go, this is going to. But now I'm going to say, right, have discipline, run the figures, take your time, because what I've seen of late, it's worth waiting for results. In a bull market, pretty much, you don't have to. But these days, I've seen so many companies go down on the results, because the market's very hard. So, and you get results, you get more data anyway, so you can see, okay, they're not. No,
you're right. I mean, even if you beat estimates, you still get taken out to the woodshed. I mean, there's one I bought, flagged Pfizer, and it's world-renowned $200 billion biopharma business out in the States. It's obviously famous for its vaccines, but it's also into things like oncology and a whole bunch of other stuff, other sort of therapeutic areas like pain relief. It beat its first, EPS expectations in Q1, and had a strong start to the year. It's still going ahead, obviously, with its Seagen acquisition, albeit that may get pushed back by the medical authorities. It's currently trading on an 11 times PE ratio. The shares got dropped by 10%, even though it beat on its forecast. So that's one. I mean, Roche which is another one which I bought, again did well in is in line, etc. in the first quarter. That's done okay. It's about the same. And then there's another one I've just bought, actually, which put out an increase in EPS, where basically it beat its EPS forecast, it beat its revenue forecast, generated about 10% like-for-like top-line growth. It's trading on, what is it, basically 12.5 times PE, solid balance sheet, hardly any debt. It won't by the end of this year anyway. It's got a market cap of nearly 70 billion, and it raised guidance. So you'd say, bloody, it's growing at 10%. It's got operating margins of over 20%. It's in tech, it's in software, and it's trading at 12. you know, what gives, and then you learn it's actually the name when everybody hates it is called PayPal. So I've just bought a first position in PayPal because I don't know when the downs, you know, when it's going to bottom out. It just keeps going down. I mean, how a company this size and this growth with these margins and a solid balance sheet is trading effectively no growth at lower margins is just beyond me. And the reason why the shares sold off 15% was the market got a bit spooked that the growth was being largely driven by its B2B white label business that effectively acts as the checkout technology behind large e-commerce websites, or should we say, you know, players of the, so for instance, if you've got Nike who want to basically do a direct to consumer product, they'll supply the pipes to be able to do that checkout for their customers to take all those payments in. And that saw 30% growth. Their branded business saw 6% growth. And so they had a blended of about 10%. But they got worried about this because it was a mix, and therefore they wouldn't increase their operating profit margins by as much as they originally anticipated at the start of the year, which to me is a high-class problem. And so the market sold off 15%, thinking actually, you know, the unbranded is not worth as much. And given the economic climate, it will actually, you know, how sustainable is that growth? But I know, you know, from basically, you know, things like, you know, Equals and Argentex, that effectively, you know, the solutions businesses, as more companies decide to do straight through processing, that is growing well. And this could be a real sort of like, you know, Trojan horse for them into selling their higher value branded stuff as well. So I looked at it and just thought, this is a gift to me.
When did you buy it then?
Sorry, when I bought at the start of this, I bought at the start of this week. So I'm slightly down, but frankly, I don't care because, you know, I mean, it wouldn't be surprising to me if Microsoft put a number on these boys, because they need payments to compete with Apple and to compete with Google and people like that. And I just think what it is such that it's come down from over $300 at its sort of like heyday 2 years ago in the midst of the pandemic when everybody was doing online transactions. It's now trading at 62, just south of 62. Yeah. And I look at it, 12.5 times PE with a cash flow yield of over 7%. It's just frankly mispriced to me. It's saying, in my view, it's valued on the basis that there's no growth and they're going to have a deteriorating margin for a huge brand that's well known and, you know, around the world, that's got fantastic, you know, technology, etc. And I mean, you know, you say, is it a value trap or is it a value play? I just think it's mispriced. I really do. Either way, how you want to play it, it's totally mispriced. So as I say, I can't call the bottom. I've never been good at that. I've never been able to call the top on these things. It just looks to me, you know, and let's be clear about it. As I repeat, 37% of my selections lose me money. So I could be wrong on here, but to me, this looks like a gift. And therefore I just thought, right, okay, I'm going to put a position on it. I mean, I've still got plenty of cash, but I just thought, right, okay, I'll open it. It's dead easy. I can, you know, trade it into my AJ Bell SIP, which does Forex pretty easily. No stamp duty, so it covers the Forex cost. I'll hopefully hold it for about, you know, sort of like, you know, 5-10 years and see how it goes. My fair value on it is modest. It's only 85. Wall Street consensus is about 95 to 100. And again, I think there's once it, if you think about a software firm that's got good high margins, excellent cash generation, growing at nearly high single digits, nearly double digits with 20% profit margins, then you just look at it and just say, well, that should be on 20 times, you know, PE, easy. It's on 12 and a half. Anyway,
why is it just worry about competition or, you know, new payments?
Yeah, there's a bit of worry about competition in terms of, you know, Apple Pay and Google Pay, but I think what the people are slightly missing or confusing is that Apple Pay is only available on iOS, which is okay. It's a big chunk of all the mobile devices around the world get it, but it ain't on Android because there's no way Google is going to allow iOS, you know, it's going to allow Apple Pay on its, you know, and likewise at Google, it ain't on Apple. So if you want a service that is basically going to be ubiquitous across all devices, all technologies, vendor agnostic in terms of handset, then Venmo, which it owns, and, you know, mobile PayPal, which it owns, then we'll be able to do that. It operates on iOS and onto Google. So yes, you've got big competition from these guys. They will, no doubt about it, be successful. But this market is growing. And at the lower end, in terms of, the fintechs of the classic sort of like, Revolu's and people like that, then I can actually see these guys are really going to struggle as the cost of capital rises, interest rates have increased. They're going to have difficulty raising new money to fund their expansion. And this game of growth at any cost is over. So I actually think the lower end of the fintech competitors, they're going to fall out of the market. So I actually think they're going to have less competition from the bottom end, which is just, hey, we just give it away for free. And they're going to get competition more from, Amazon. Sorry, probably. I mean, they'll have their own checkout. Amazon will, but they get ready from Google and from Apple. But they don't. But those guys don't cover all the, all the technology platforms like PayPal does. So yes, there's a risk. Don't get me wrong. I'm not ignoring that, and I don't totally accept. I just think it's totally overstated.
Yeah. No. Well, that's it. Sometimes you take the plunge, haven't you? I was looking on. I put some forecasts in for future, and even if there's no growth on current margins over the next 3 years, it's like almost triple-digit upside compared to where they have been. It's not on crazy multiples either, Yeah. So sometimes you go, okay, where's it going to be? You're going to go. Do you know what I was looking at? Joel Greenblatt. I think he came up with the magic formula a while back. Did you ever hear this? He tried to make investing very simple for people because there's so many metrics. Yeah. He said, right, how to make it very simple. And this magic formula was based on 2 metrics. I think return on capital employed it was, and dividend earnings yield, which basically the backward PE.
Yeah.
And looking at that, and so I thought, let's have a look at this. So let's put a screen up there, and I looked for high capital, return on capitals, all that stuff, and I came up with a Hargreaves Lansdown. I thought, that's amazing. What's your thoughts on Hargreaves Lansdown? Because look at their return on capital employed. This is the interims, 61%, and they are now trading on pretty much a PE of 12. Based on their interims there. And I think that's amazing. I mean, I think there's lots of opportunities out there. And I understand there's a bit of competition there. You mentioned AJ Bell's competition as well for these guys. But I think there are some quality companies. This has come down from like the share price at 30 quid a while back. And now it's down at this 8 quid, You're thinking, well, no, the 20 quid a while back. Yeah, so they're high in that. And I thought, that's a very good business, a very efficient business. The margins are so high. Okay, the growth not maybe crazy, but even the interims, their growth was getting better. This is the kind of company that, like I said, at the moment, people are not invested the scale of the stock market, but when the market turns, and I think they announced, so the last quarter was net inflow, only small, but it's getting there. And they say a lot of fund managers now are saying we've seen this outflow slow down or stop, and we're starting to see some inflow happening. And that when the market turns, companies like this, they're very efficient, would do quite well, and the dividends at 5%. So there's lots of opportunities out there, isn't there, to look at.
Yeah, no, I think that's a good idea. I'll have a look at that myself to a certain extent. I mean, I'm less interested in a sort of IPR heavy type business of return on capital employed, but that earnings yield, or the 12 times PE ratio looks attractive, because you're right. It's just basically, it's a great platform that generates a shed load of money. I mean, the final bit on which, I don't think investors have seen on PayPal is actually, it should be a major beneficiary of AI, because it's got huge amounts of transaction data that it can actually start mining and using as selling as a service, like the likes of Barclaycard do, Mastercard do, Visa do. So if they put that overlay of service onto the top of it, because I mean they've got 430 million customers. I mean, isn't as though it's a small platform. So on that basis, they start mining. I mean, that's twice the number of Twitter. So just to put it in perspective, huge amounts.
So that in itself, isn't it? I mean, for maybe a target, like you say, you'd want that. Something like Microsoft would want that data, So
absolutely, I mean, another one on the AI that I own, which came out with some pretty good results, they came out with an announcement today. It was First Derivatives, FD Tech. And I mentioned about when I bought it 18 months ago that they just inked a deal with Microsoft Azure to use effectively their cloud platform for doing real-time data analysis, data mining for all the sort of the capital markets for the major sort of banks and stuff like that. So your JP Morgans, but not your really commercial bank, but really sort of like your merchant bank, all these sort of like the trade data and stuff like that, because that's where their sort of bread and butter is. Well, today, this morning, they said they were just linked a similar deal with Amazon Web Services, and I saw the shares up nicely 3% today. And I think they'll be a beneficiary of AI because they've got effectively the pipes, the technology to be able to provide the information and data that then you then run the AI platform on top to be able to give you the insights and to improve your productivity. But you need that level of the picks and shovels guys to be able to take the whatever data it is, could be, at the edge data from EVs. It could be, it's obviously the financial markets data where there's massive amounts of data. Could be anything where you're collecting huge amounts of sort of like, data in real time, and you need real time processing to give you that particular edge. And these guys are the best in class by a mile with their KX Insights business. So I actually think they could do pretty well. Very happy to hold. So yeah, it's a nice sort of like way into AI. I would say on a broader point of AI, you've got to be very selective of where you go, because there's a lot of capital being deployed, which is going to, it always says to me, it's a massively crowded trade. Prices are being bid up for these, particularly the pure play AI players, and it's just going to be hugely, competitive, and it's going to be given away for free. So, you just got to be very astute of how you put your money and put it into the picks and shovels guys who are effectively betting on all horses and for the industry, like FD Technologies. Not a daft, approach. Shares are currently trading at 18 quid, just north. I mean, I got a fair value of 26 quid. And I think the house broker's on about 30, but yeah, let's see how they get on. But that KX Insight is just, as I've mentioned before, is the crown jewels of that whole business, and is absolutely flying 30% per annum. And obviously you're selling software, so it isn't as though you got low gross margins there.
Yeah, so we normally cover, it's funny, AI, I don't know what it was. Was it like something like the mention of AI and products mentioned by Google, Microsoft accounted for a rise, or the S&P rising in the last month or so? I don't know what the was. But
yeah. Well, it's really been driven. It's driven most of the gains in the S&P 500 for the last 4 months for this year to date. If you look at who's been doing all the heavy lifting, it's Microsoft, Google, Facebook, Apple. All the sort of like guys who are your number one players in deploying, sort of generative AI. So, and obviously NVIDIA, don't forget those boys. Anyway, I don't want to get too excited about it, but it's who's got the data and who's got the platforms to be able to do it. And you could equally say, likes of Equals and Argentex could be good beneficiaries of it as well, to help their clients' performance. And that would be all upside, because you're still going to need expertise in terms of helping your clients, put the Forex trades on, whether it's, basically futures or forwards in particular, which Argentex do. And if you put in a layer of effectively really smart straight through processing, then it's all jam tomorrow, isn't it? It's gonna. If they can put it this way, if they can deploy generative AI or AI better and quicker than traditional banks, then they're going to accelerate their market share gain. And let's be clear about it. Who would you bet? HSBC to put AI in, or Equals, or Argentex? Yeah. I would go every day of the week.
You're exactly. Small companies can be more flexible and move quicker, can't they?
I know.
Turn around tankers.
Exactly.
Yeah, it's phenomenal. But we normally start with macro. But what do you think at the moment? I'm still, like I said, the reason why I'm in cash, I still think there's something, we're due some kind of sell-off. This a nagging feeling in my head. Even though the markets are going sideways pretty much, they're not reaching new lows. There's a part of me, I don't know whether it's just perception or what, that is not ultra bullish,
No, I mean, I think you're right as well to a certain extent, because I know we don't want to get into a bear fest, because we're both naturally quite positive and sort of like optimistic guys, because we wouldn't be if we have to be invest into where we go to. But I did think there was quite some significant data this last 2 weeks that's been largely ignored by the market, and that significant data is the Chinese reopening is spluttering, and you're seeing that through the decreasing oil price, and you're also seeing it come through on lower, industrial metals and commodity prices as well. And let's be clear about it. When we entered the year, the big hope was that China's going to put on a 1.5 million barrels a day of demand on the crude market for 2023, and is going to drive that up, and is going to start developing with infrastructure and property and all this sort of stuff again, and is going to really have a surge in the copper price and in other commodities, and that hasn't happened, and it's fallen to pieces. Yes, the consumer is enjoying holidays domestically and is spending on restaurants like they are here as the reopening goes. But actually, the heart of China has spluttered, and I'm a bit concerned actually that could take some of the juice out of that particular trade, particularly the people who are saying things like commodity super cycle nowadays. Because if China splutters, they're the main, demand, their main users, the main customers of all these industrial metals, and a lot of people are trying to catch a falling knife in things like Freeport-McMoRan, which is the biggest sort of copper producer out in the States and stuff like that. And I think there's going to be more, contraction. And likewise with oil and stuff like that, the oil stocks haven't really come back. They have, but they haven't really fallen as crude has fallen as you'd expect. And I could still see crude actually going into a net surplus position at the back end of this year, rather than what the market at the start of the year was going to be a net, deficit. So I'm with you. I would be cautious. I'm cautious macro, no doubt about it. And if you look at the sort of what you expect for EPS going forward for corporate profits, as I mentioned before, 2024 S&P 500 EPS expectations is running at about 245 per share. Okay, I just think that's got to come down, and let's assume it goes relatively flat 2024, because I think that's where the recession will really start kicking in. Let's assume it's flat on 2023, and 2023 is at $220 per share. So if we get a flat into 2024 to 220, you stick a 16 times multiple on it, you get 3,500 on the S&P. It currently trades at just over 4,100. You're looking at a 15% decline. So yeah, I'm with you. I think there's going to be, overall, it doesn't mean you can't select stocks sensibly, and as long as you've got a good time horizon, but I think the overall tide is actually going out, or will start to go out. You could get the time. When will it happen? When will actually the rubber hit the road in terms of the stock market? Well, it usually works sort of 6 to 9 months in advance. If we're looking at a recession Q1 next year, back end of this year, in terms of what I've just said, because that's when some of the the consumer spend starts tiring off, etc. If you do get that, then bring it forward 6 months. You're looking at a correction round about pretty imminent, actually, mid in the summertime. And I would not be surprised. The thing that triggers it is if the Fed in June says, I'm hiking rates, or I'm pausing on rates, but I'm definitely going to hold for them, for the considerable future. If you see that dot plot go out as a flat line deep into 2024, then you're going to get that the two sort of opposing forces of the Fed forecast versus what the bond market's saying, i.e. cuts in interest rates. That is going to be the trigger for it, because then because what's also powered the S&P is the expectation that interest rates are coming down in the States. It's giving you higher valuations, multiple expansion. I know that's a long-winded answer, but I'm with you.
Yeah, no, I think at the moment, unless you actually see, there's nothing that exists, it's a no-brainer. But if something is so compelling, like you say, you looked at PayPal, so that for longer term is fine. But it's not the time to jump in on speculative calls and say, oh, that could make us money. I mean, deep research is needed at the moment, I think. And if you're absolutely convinced, beyond convincing, almost a steal, then go for it. But yeah, that's why I'm sitting on a bit of cash. And now it's going to be a bit more disciplined, because I do think there'll be opportunities out there coming forward over the next 3-6 months. But
just the difference between, I mean, you've seen what I've bought this year: big cap, major brands, Pfizer, Roche, and PayPal. I am not jumping into small caps at the moment, because I still think the headwind in terms of going into that space. I'm heavy into small caps with EQLS and Argentex and people like that anyway, and FD Tech. So there's a portfolio sort of like construction angle to it, no doubt about it. But with interest rates staying higher for longer, it's going to damage the balance sheets of small caps more than it is large caps. Once that changes, that dynamic changes. I mean, the Bank of England, for instance, is likely to raise interest rates again in June. I mean, you've had Andrew Bailey saying, we may be on hold, but actually the market's saying it's going up by another 25 basis points. And on that, given that sort of backdrop, it's going to be increasingly hard, one, for small caps to access new capital, just to roll over existing debt. But if you're a small cap who actually wants to raise money, i.e., you need it for replacing, well, hey, good luck with that, because it's whoever you are, whatever brand. I mean, just put yourself into, Superdry. They would not have got away with a, can't remember how much it was, £20 million placing at a sort of steep discount to what it was, unless, basically the founder had put in 12 million of that. They just wouldn't have got away with it.
Yeah, no, there a few microcaps I've seen I really like, but they don't have cash. I thought, I'm not going anywhere near them. And a couple of them have rallied, and I thought, and they've rallied quite strongly. I thought, I'm still not going to get anywhere near there. It seems like the trend has changed on the share price. I'm not going anywhere near them because they've not got cash. In fact, a bit of a lesson in the microcap space. There's a company called Nanosynth Group this week. I don't know if you saw that.
No.
But it literally rallied a few days back, about 46%. The volume went up. You see lots of buyers going in there. Next thing you know, they announced AIM suspension and proposal to appoint liquidators. And the people actually ramped into that somehow on Twitter. People said, "Oh, get in there! It's going to the moon!" And all of a sudden, your money's gone. That's it. It's in the money pit. So, got to be careful. At this time in microcaps, especially, make sure they got plenty of cash. So they're 12 months at least, of cash.
And even if they have got, cash, you've got to worry about it. Let's be clear. I put one of my less good investments, shall we say, 12 months ago, Purplebricks. Okay.
Oh yeah.
I put a big chunk into Purplebricks, a good full size position, etc. And because it had plenty of cash, and I thought the brand was going to be, you could turn that brand round. That was where I got it wrong. It was pretty damn impossible. Whatever management team, it was just a broken brand, and people weren't going to sort of go back to using it. And I got out, with an 80% loss. So I went out with a big 6-figure number, loss on it, etc. So I got out about a 7.5p. Well, this week, I mean, it's gone to zero, hasn't it? Just about. They sold the whole business and assets for £1, and it just shows you, even if the company has got lots of cash. When I invested, it had, I think it had about 40 million of cash.
Yeah. I remember seeing 30 odd million. I thought, they've got plenty of time to get this right. And then you realize how much cash they're getting through. Maybe
it's only 12 months, and it just shows you how things can change. I mean, the only fortunate bit, the learning bit, that, I mean, I got it wrong in terms of, sort of on the brand side. I stayed true to my rule that, I'm not doubling down on it because I frankly, I could be wrong on it, and I am wrong often. You just got to accept that. So I didn't double down on it. And then back in February, the trigger point was the banking crisis. And I just thought, actually, this is just not going to, they're at that, when they announced the potential strategic review that they were going to sell, or, sell it to a buyer, I just thought, who's going to step into this week with the bank lending and bank tightening? It's going to be a really tough one to sell. And that's why I thought, right. And that's when I sold Boohoo at the same time. Got out of that.
Often it's like this. As investors, we often go into things looking at the reward, absolute upside reward. That's all we think about. But I've said recently on the webinar, I say, focus on the risk first. What can you lose? What can go wrong here? Because if that plays out, if the risk plays out, there isn't any reward. But if the risk doesn't play, there is a reward. So we always look at the wrong way around sometimes. You think, okay, what can I lose here? What's the worst can go wrong? And play into that scenario first, and then allocate your exposure as appropriate to that risk, because, in high risk stocks, especially in a downturn, the worst can happen,
Yeah. Anyway, I'm glad I got out eventually, but I haven't got a smile on my face because it cost me a shed load of money. Likewise, with Boohoo, got that one wrong, and then the other one I sold for Q1 was Roslin Datatech, another one I got wrong. I thought that could be, and it just shows you such that you're gonna make mistakes, and you've got to accept it, because if you don't, then you won't invest in the winners as well, like EQLS and Argentex and people like that. So you do need that, but what's also required for successful investing is a long-term time horizon and broad shoulders to go through the dips. I mean, as I say, I've bought PayPal. That could easily get down to $50. I don't know. With if somebody keeps selling and selling and selling, it'll go down to 10 times PE, which would be $50. But I'm happy to hold, because at some point I do believe, given their sort of like operating margins, their growth, and the strategic value of that whole platform, that it will be much higher than 60, $62 is where I bought. But I could be wrong. I don't know.
And not only that, when you think about it, a lot of this game, what I like about, and it is a game because, we're only here on a temporary basis. I know it's painful, but it's the learning. When you understand it, it's the learning that's almost the thing. That's the game, It's not about making millions and, retiring to a beach somewhere if you can. It's not that. It's a constant learning. It keeps your mind active. And that's what life's about, is trying to figure out a better way of doing things. And that's why humans are about that, about evolving, essentially. And that's to me, that's the entertainment here. And of course, it's gutting when you get something wrong, but treated like that's a lesson learned there. Next time going forward, I should avoid that kind of thing. But I know.
No, you raise an excellent point, because it's clearly the market is positive stress to you and me. Yeah, it's not, if it's negative stress, if it's actually giving you health problems or mental issues, then stop it. But to me and you, yes, you get a kick in the proverbial at times, but frankly, overall, it gives you far more positive stress than it does negative stress. And that's the key, because it makes you're healthier, it keeps your mind active, and you learn a lot. One thing also, just to mention, if anybody wants to sort of like see me sort of like and quiz me on all my investments and my 30 years of sort of like selections and stuff like that, I am presenting at the Mellow event, in-person event down in Chiswick, first thing on Wednesday morning at 8:30 for an hour. So I'll be happy to take anybody's questions during the presentation and obviously afterwards. So if they want to come down there, then please do. I did post on Twitter, there is a discount code about 50% that the guy who's running it gave us. So I think he gives everybody at 50%. But anyway, if people want to come down, it'd be great to see you, and I'll answer questions. So we'll have a bit of fun, talk about stocks over breakfast. Not bad idea, eh?
Yeah, exactly. Well, you say that you're presenting a Q&A, then a song afterwards. I was surprised that I didn't know you were in Singapore, so that's worth it. Marvelous stuff. Thanks for that. We'll speak in a couple of weeks.
Cheers. Bye.